My name is Nick, and I'm going to break down how you can buy a house in 2022. I'm an independent loan officer for the One Brokerage, which is one of the fastest growing brokerages out there. And in my experience of doing loans, I'm going to go ahead and share what I think is the biggest things you need to know. Keep in mind that every situation is unique, but there's three main things that you need to focus on if you're trying to buy a home. These three things are credit, income, and down payment / loan products. If you want to buy a home, but you're currently not shopping for one, comment below and let me know why that. If you want to buy a home, it's an absolute must that you have credit. If you don't have any record of you actually repaying debt, then no bank out there is going to lend you any money to buy a house. As far as what credit score you need to buy a home, it's going to depend on what loan product you actually choose. Conventional loans will go down to 620, while FHA loans go all the way down to 580. On the loan side, credit scores are a sliding scale. So the better credit score you have, the better the interest rate will be. So while you can go down to a 580 or 620 depending on the loan product you choose, if you have a higher credit score, your interest rates can be significantly better. So there's different categories. So for example, from 620 to 660, you'll be at this interest rate. From 660 to 700, you'll be at this interest rate, and so on. Most lenders, it varies per lender, but typically 740 and up usually provides the best terms. Keep in mind that if you have a co-borrower, whoever has the lowest credit scores, that's going to be used for qualification. If you happen to not have credit, that's absolutely where I would start because it's the most integral part of the whole process. Down the road, I'll make a video on how to get credit and how to improve upon it. Your income history will be the second biggest part of getting a loan. Now, when it comes to income, lenders typically want 2 years of history. There are exceptions to this, like if you were in college and you got a degree and then you went and worked in that specific field that you got a degree for, that can be used as employment history sometimes. But just general rule of thumb, you want 2 years of employment history. There are different loan programs out there for like 1099 workers who only have 1 year 1099, but we're just going to talk about just the general basics. Now, if you have 2 years of employment history, the second biggest thing to look at when it comes to income is going to be your debt to income ratio. Your debt to income ratio is how much debt you have divided by the income you make every single month. In an ideal world, you want to be below 45% debt to income. Now, if you're wondering, how do I calculate my debt to income? It's actually pretty simple. First, what you want to do is take all of your liabilities and add those up. Now, when I say liabilities, these are things that are going to populate on your credit report. So things such as car insurance, phone bill, stuff like that, those don't count towards your debt to income. Your car note, on the other hand, or previous mortgage payments, student loans, and things of that nature absolutely will be on your credit report, so you need to count for those. Once you add all that up, divide that by your total income for the month, and you'll have your debt to income ratio. To get a home, your debt to income, including the proposed mortgage payment, needs to be below that 45% ideally. So what I would do is go online and type up like mortgage calculator, enter in all the information on the purchase price that you're looking at, stuff like that, and then take that number, add it to your total liabilities, and then divide it by your income. If it's below 45%, then you can probably get approved for a mortgage assuming all your numbers are right. Now, there are scenarios where you can go over 45% debt to income, but you need to have compensating factors. This decision is done by an automatic underwriting system, so lenders really need to have all of your information in your credit report to let you know if you would get qualified over that 45% number. Keep in mind though that 50% is pretty much the cutoff for all loan products. Now, once you have a general idea if whether or not you actually will get approved for a mortgage, the next big thing is how much money do you have for a down payment and what loan product you actually want to use. As of right now, the only 0% down options are going to be your VA loans, which is for veterans, and USDA loans, which are for rural properties. If you don't fall into either of those categories, then you're going to be putting down at least 3%. Now, what's awesome is if you're a first-time home buyer, you can do a 3% down conventional loan, and conventional loans typically have less stipulations than FHA loans. Now, if you're not a first-time home buyer, you can do an FHA loan at 3.5% down or 5% down conventional and up. Keep in mind that this is only for primary residences. If you're going to purchase an investment property, things change a little bit. Besides your down payment, you will have closing costs as well. So add another 3% of the purchase price into your calculations for how much you actually would need to purchase a home. Let's say that your debt to income is low and you have great credit and you know which loan product you want to use and you actually have the down payment to do so. So here's a few things that you can do when shopping for a house to get your offers accepted in this competitive market. The first and most obvious one is to get pre-approved for a mortgage. If you're submitting offers right now and you don't have a pre-approval letter, a lot of listing agents are not going to take your offer seriously. So the first thing to do is find a lender who will give you a pre-approval letter, and then ideally they'd call that listing agent on your behalf and advise on the strength of your pre-approval. One great thing to do as well is to try and lower your inspection period. What I would do is call around to different inspection companies in the area and figure out what their turn times currently look like. From there, be conservative, but lower your inspection contingency as low as you can. Ideally, the lower the inspection period you can do, the better. Other than shortening your inspection period, you can also lower your close of escrow as well. To do this, you need to find a lender who can actually close in a shorter time frame than others would. Sellers absolutely love shorter escrow periods because it means they get paid faster. So if you can close in 21 days and your competition's closing in 30 days, you might have won yourself a contract right there. That's just a really fast, quick breakdown on how to buy a home. It's really not as complicated as it seems, but if you haven't gone through it before, it can definitely seem very overwhelming. And a lot of these things you can find online and just research yourself. It's super, super easy. But if you have any questions, you can put them below, and I'd be glad to answer any loan questions that you have. If you enjoy real estate content, make sure you subscribe because I'll be making a lot more.